Okay. So as you've all heard, we are recording the webinar. So good afternoon to everyone, and welcome to our webinar, Key Wealth Building Strategies. Learn more about how to grow your personal wealth. As I've mentioned before to everyone, we are recording the webinar. And today we are very fortunate to have two fantastic presenters. Firstly, we've got Zvi from Financial Priority Advisor, and Zvi is a financial advisor and a director at Priority Advisory Group, and he advises and guides his clients on all financial matters to help them reach their life goals. Our second speaker is Mark Williams, and Mark is the Managing Director of Imagine Accounting. And today we're really keen to keep the presentation as interactive as possible. So please feel free to pop any questions that you have during the webinar in the chat box. And then just to let you know, we do have our standard disclaimer. So if you can just move to slide 2, please. Yep, so we do have our standard disclaimer as well today, just to let everyone know that the presentations isn't advice. And then slide 3, please, Zvi. And then just to let everyone know today what we'll be covering. Zvi will be covering the wealth building strategies. As you can see, we've got the 4 topics there. And Mark will be covering the tax strategies for wealth management. So on that note, I'd like to welcome Zvi to start his presentation.
Thank you, Jennifer, for that lovely introduction. Welcome everyone to the webinar. Firstly, I just want to say what a privilege it is to work with Imagine Accounting on this webinar. It's our first joint webinar between our 2 companies. I hope everyone enjoys it, and I believe there'll be a feedback form sent after this webinar, so any feedback would be appreciated, and if there's any other topics you'd like us to cover in the future, keen to hear about that as well. I'll just launch straight into this now. So the topic is around wealth creation and goals-based investing. In the whole world of a financial advisor's practice and how we help clients, it's not so much about just how do we create more wealth for people, because unless there's a particular goal you have in mind or a particular aspiration you're trying to reach, it's really hard to plan properly around what investments to choose, what structures to use, and those sorts of things. It is possible to have a particular goal around just creating as much wealth as possible with no particular end goal, but most people do have particular benchmarks that they're trying to achieve throughout their life. And that really does help in determining what investments people use and why. So as you can see on this slide, goals-based investing is an approach that helps people meet personal goals. And most people will have numerous goals, and we like to split them between short, medium, and long term. And we think about these different timeframes. We talk to people about buckets of timeframes. And you can see here through the pictorial that the first bucket is generally around safety. And that's around what do you need right now to make sure that, if you're supporting a family or you have no dependents and potentially are retired and you want to make sure that you can live right now and go out, have a coffee, go to see a movie, put food on the table, make sure you can cover your accommodation costs if there's a mortgage or you're paying rent, even things like utilities, gas, electricity bills, those sorts of things, which of course are all going up at the moment. That's your safety bucket. That's your immediate needs. So you need to be able to plan for those and have some reserves available, of course. Lifestyle is the second bucket. So that's around medium term. So what are those things that you're planning on doing in the next year or 2? Planning for a holiday, overseas trips, potentially upgrade a car in a year or 2, any gifts you may like to give to other people. So they're all things that we talk about around lifestyle. And the last one there, the third bucket, is future. That's much more longer term planning. So depending on what stage of life you're at, that could be planning for a retirement in 10 to 15 years. It could be, if you're much younger, planning for starting a family or buying your first home in the next 5 to 10 years. So that's the third bucket. Now, each of these buckets do have different risk profiles, and I'll talk to that in a moment. So we're going to cover 4 steps in this presentation. The first one is about thinking about your needs versus your wants, and I'll cover that in a moment. Allocating resources to particular buckets, as I mentioned, and very importantly is reconciling the risk you need to take to achieve those particular goals. And risk is a really big topic, especially at the moment if you've been keeping up to date with what's happened this year on investment markets and inflation, and all these things are significant risks that can take a big chunk of person's wealth savings, etc., if they're not mitigated or planned for properly. And the last step will be to determine the right investment solution. So the first step is about needs versus wants. And I think it's important to pause at this moment and just talk for a few minutes about budgeting and what needs and wants actually mean. So you can see here how we would separate the two. A need is obviously something you need to have to live. It's a conservative approach to investing because this is money that you know that you're going to have to tap into in the short term. So we don't want to invest those types of assets in longer term assets or growth assets like shares or property that, property might be illiquid. You can't just sell a bedroom of an investment property if you need access to funds quickly. Whereas wants is around aspirations. And when it comes to budgeting, you can see on the right-hand side there, the chart that we have. The key, I guess, the foundation of all wealth creation is having a surplus cash flow position. Okay, now what that means is that, in short, basically you're spending less than you're earning. So your income that you're generating is more than covering what your needs are, wants are that you're spending on. So budgeting is a really key aspect to a wealth creation plan. And there are lots of different ways that people will do their budgeting. Some people just, every time they buy something, they'll jot it down on a piece of paper. And at the end of the month, they'll reconcile all of that and realize, wow, okay, I've spent this much money on all these different things, groceries, as I mentioned before, electricity bills, entertainment, movies, etc. Those are your needs. And if you can have a look at what that budgeting shows you, you'll then know what is left over to then build that longer term plan. Now, leveraging your budget to create longer term wealth is key. And when you think about what levers you have to make that work to be more successful or less successful, it's going to come down to your budgeting and what you're spending money on if you want to create more surplus. And that's where the needs and wants become quite important. Separating the two of them. And if you can be very clear and articulate out of everything you've been spending in the last month, what did you really need and what was more of a want? You can then put a question mark on those expenditure items that were wants and see if you can give them up or not. And if you can, how much extra wealth will that create in the long term? In terms of budgeting tools, if anyone's interested in doing a budgeting exercise, there's some really great tools online. The one that is very reliable, it comes from the government. So the Money Smart website, it's moneysmart.gov.au. That has a whole range of resources for people to look at. There are plenty of others online, or it can be as simple as jotting down on a piece of paper what you're spending and what you're earning. So I spoke a little bit before about timeframes. So we would always consider timeframes in short, medium, and long term. And here are the sort of timeframes that we think about. Less than 5 years would be that shorter term, medium 5 to 10, long term 10 years plus. Thank you, Mark, for putting that link in the chat. So the Money Smart website is in the chat box now if anyone's interested to have a look. It's important also to prioritize. If you've got a number of goals in the first 5 years, you might want to prioritize which one's more important than the other and know that you're going to work towards those because sometimes you can't meet all of them at once. So it's important to prioritize each of those. So the second step in sort of objectives-based investing, so investing for a particular objective or goal, is allocating the resources into specific goal-focused buckets. So I'll just spend a moment here. You can see that the safety bucket are the goals that are essential. So your needs that we spoke about before, generate a minimum income level that you can meet those expenses. These are the highest priority goals, the most important things to you. So for example, if there's a family and they are choosing private schooling for their children as a really high priority goal, that's going to take priority in the safety bucket over going on an overseas holiday at the end of the year. Be nice to do both, of course, but you do need to prioritize those, and that's where that safety bucket comes in. Lifestyle, these are goals that are a bit longer term in nature. So this would be the 5 to 10 year goal time frame. The funding of these sources of, may not be sufficient right now, but you need to create a bit of wealth to fund them into the future. Some of these goals might be lower in priority than the safety bucket. And you could potentially take on a little bit more risk in the way you invest for these goals, because you've got a longer time frame. So we'll talk a bit more about risk in a moment. And the last one there is the future. These are the longer term goals. You can definitely take on a bit more risk. And a good example of this might be, for example, someone in their 20s and 30s who has a bit of superannuation. They can't touch that money, until they're at least 60. So that time frame for investing means that unless they're extremely conservative and don't ever want to see their assets move up and down in value, they could potentially invest in things like shares or property trusts, etc., which we know historically do pay a much higher rate of return over the long term. Just disregard this year, for example. But ordinarily in the long-term investment cycle, property and shares are what we call growth assets. They do have volatility attached to them, but they do, in the long run, have a higher rate of average return. So that's why taking on that risk with a bit more volatility has a more appropriate place in that future bucket. It's important while we're talking about this topic of risk. So the third step is reconciling the risk you need to accept to achieve your goals. And you can see here these 3 different bubbles where you've got risk capacity, which is the amount of risk that you can afford to take to achieve your goal. And that speaks directly to the example I just gave. So, you can try and grow your super as much as possible if you're in your 20s and 30s, and you could afford, quote unquote, to take on more risk because you've got a much longer time frame. So that'd be in that future bucket. We need to also take into account things like your risk tolerance. So that would be around, how do you feel when you see your investments dropping in value really quickly? How do you feel when you see your investments rising really quickly? There's a lot of work, academic work being done on behavioral finance and how people behave when they see certain things happening to their investments. There is, just as a side note, it's interesting that, when people have, when they see their investments dropping, the emotional impact can be almost double that of watching their investments rise, because someone's fear of money falling versus money growing is much greater than the other. So risk tolerance is really important. At the end of the day, you have to be comfortable that the assets you're choosing may move around in value or may not, depending what you're choosing. But if they do move around and you're not comfortable with it, there's no point in losing sleep every night and being all stressed about your funds. If you're not going to tolerate that risk, you should probably be in a different type of asset class. Excuse me. And the last one there is the goal risk. So that's the risk you need to accept in order to achieve the goal. One of the things we speak to our clients about a lot is that every decision you make financially is going to have a trade-off, right? So trade-off discussions are really important. So when you think about a goal risk, in order to reach a particular goal, you may need to trade something off. And again, it comes down to prioritizing. So an example of that might be, want to take an overseas trip next year, can't afford it right now, do some sums, have a look at how much you need to generate or build up in savings. That might mean that you're trading off or giving up or foregoing some of those wants this year in order to get that goal for next year. So that's a risk you need to take, that you're happy to give up a particular type of short-term need or want in order to get to a particular goal. And those trade-offs are very common in any financial decision-making. Determining the right solution. So basically here, I'm going to spend a few moments about asset classes, because at the end of the day, when we talk about wealth creation, there are lots of different things people can invest in. You can see on this slide, we split the, on a very basic level, we'll split assets into growth or defensive. And then within each of those categories, we have shares and property are generally growth assets. You can include in that things like private equity, those types of investments. And then, of course, defensive is cash and fixed income. Within cash, we would consider things like term deposits as cash. We would consider high-earning bank accounts, which up until recently haven't existed for many years. But those types of things are cash. Fixed income is a very broad asset class, and that asset class is predominantly based on bonds. So bond markets, and they could be treasury or government bonds, or they could be corporate bonds, which is effectively like, issuing bonds or lending to corporates and governments and so on. That's all lumped into a fixed income asset class. So those asset classes combined give you effectively a broad range of an investment menu to choose from. And the challenge will be, what do you choose to invest in? Or do you choose a mixture of all of them? Going back to those original slides, you can now see how cash and fixed income, which are defensive, need to always be factored in for those shorter term needs. In terms of the buckets that we were talking about, that would be the safety bucket and potentially some into the lifestyle bucket. Future buckets, which are much longer term, they could be those shares, property, and those sorts of things, which are going to have some volatility, but over the long term will actually provide a better return. So in terms of choosing the right asset class, rather than choosing one over the other, we would always talk to clients about a mix. So the old adage of, don't put all your eggs in one basket. We know that having a diversified approach to assets always leads to better outcomes for clients and investors, particularly when it comes to trying to reach a number of different goals in the one investment portfolio. So if you have a look at the chart here, you'll see what we call a proactive asset allocation. So this is where you would mix a different percentage of growth investments with defensive investments. And depending on your time frame, it might be 30% towards defensive, 70% towards growth. That could be a 5-year time frame, for example, and so on. But you can see that over a period of time, the returns will change depend on the asset classes that you're in. And having a diversified approach means that you're not trying to pick one asset class over another. Nobody has a crystal ball. Nobody knows exactly when shares are going to fall heavily or rise heavily. People often say they do, but getting that timing right is an impossible task. And the same with bonds. So nobody really knows when they're going to rise or fall. We had a significant sell-off of bonds internationally and in Australia at the end of last year. And that came as a shock for most people, because it hasn't happened for nearly 30 years, such a sell-off of bonds. A lot more technical detail on that we could do in another webinar, so I won't bore you with all the detail right now. But the main thing to take out of this slide is that there is no right solution for everyone. Every person has to have a bespoke or unique mix of investments that are linked to the goals that they're trying to set. Otherwise, picking and choosing investments becomes a very difficult task. I'll pause there now for any questions, If you want to ask any questions, feel free to do so. And I'll just give everyone a minute to think about any questions they may have. Okay, it looks like there aren't any questions at this stage. So what I'm going to do is I'll stop sharing my screen and I'll hand over to Mark for the next part of the presentation.
All right, thank you, Zvi. Let me share my screen now. All right, hopefully you can all see that. Let me know if you can't. But yeah, thank you, Zvi. That was yeah, really good to get that foundational stuff right. And I think it's really important when we're considering wealth creation and wealth building to really not skip those steps, and certainly having conversations with clients. Often the question arises in and around, what should I do with my money? And obviously we're not financial advisors, so we can't answer that question for them. But I normally point them in the direction of stopping and thinking about what they want to achieve, and that's a big part of the discussion that, good advisors like Zvi and his team have with their clients to really understand, what are you looking to achieve? What are your goals? And that's a really important component of then making decisions in and around your investments and your planning and having that right balance in your portfolio in terms of cash versus longer term assets, to then not be in a position to have to sell or liquidate when you don't want to be and don't need to be when cycles and values change. So some really great stuff there to be mindful of. So we'll jump into the tax side now. That's obviously what we do, and a large part of what we do with clients is in and around tax. So we'll start to talk around some tax strategies in relation to wealth management. So obviously, as you create and build your wealth, you want to retain as much of that as possible. So managing tax is obviously a big part of that. So we'll kick off with a bit of an overview of tax planning. So really just to lay some foundations in and around tax, and what are the components of tax planning. So there's obviously lots of different taxes, and we're talking purely Australia here. Obviously there's international tax as well, but that's a whole nother discussion. But when we're looking at tax, we've got federal taxes there: income tax, capital gains tax, GST, FBT. And then we've got state taxes: payroll tax, land tax, stamp duty. We've got different tax rates across structures and residency, which I'll get to. And then obviously compliance is one part there. So when we're talking investments, we're largely talking income tax and capital gains tax. And obviously in relation to property, we're talking land tax and stamp duty. So in terms of tax rates in Australia, and these are the current rates that apply to Australian tax residents. So on the left there, we've got the individual tax rates, which the top rate of tax is 47% effectively, which kicks in, you can see there, at income above 180,000. The rate is 45%, and then we add on the 2% Medicare levy, so we have an effective top tax rate of 47%, so nearly 50%. So obviously, ideally, we want to avoid that as much as possible. Then the next bucket there is companies. So companies, the standard company tax rate is 30%, unless you're a small business entity and qualify for the 25% tax rate. And also, we should note there that companies are not eligible for the general 50% CGT discount. So that's an important consideration. Usually when we're talking structuring of investments and where do we hold assets, that's a major consideration there. The next category is trusts and partnerships, which typically don't pay any tax themselves. The beneficiaries and the partners usually pay the tax. In the case of a trust, we usually avoid not distributing income, because if we don't distribute income, the trustee then pays tax at the top marginal rate. So typically the beneficiaries will pay the tax, and they'll pay tax at whatever their relevant tax rate is, and whether that's an individual or whether that's a company. And then on the right, we've got super funds. So super is the lowest taxed environment in Australia. Obviously, the best tax rate we can achieve is 0, which can be achievable within super. So if you're in pension mode within super and up to the $1.6 million cap, you can be paying 0% tax on your earnings, which is, can't get any better than that. The standard tax rate within super is 15%, which is still very good. And then the capital gains tax rate, if you've held the asset for more than 12 months, is 10%. So you get a 1/3 discount there. So very good rate there. And I'll talk a little bit about that later, but typically we want to try and be mindful of this when we're looking at where are assets held, where does income flow through to, and how do we get it through to ideally the lowest tax rate. So some other considerations when we're looking at tax, income versus capital. So generally, capital is taxed at a lower rate than income tax, primarily due to the 50% discount, which I spoke about, which it doesn't apply to companies. We've also got CGT small business concessions as well, which is typically relevant if you're in business. So general principle there is understanding the difference between income and capital, and that typically capital gains are typically concessionally taxed compared to income. Residency there as well. We also need to be mindful of residency and whether that's relevant to you and or family members. And you can see the non-resident tax rates, there for the current year. There are no tax-free thresholds for non-residents. You're paying tax from the first dollar of income, and it's straight up to the 32.5% tax rate, and then kicks up to 37%, then 45%. So need to be mindful of that in and around residency. So that can be relevant if there's a change in residency. We should always be looking to do planning if there is any type of change in residency, whether you're looking to leave Australia or to come back into Australia or come to Australia for the first time. We should always be looking at the tax consequences of doing so. And there can be some very good planning opportunities in and around that. So, okay, so the next section here, we'll jump into super. So super is typically quite a big part of wealth building and wealth, and particularly long-term wealth building and creation, and obviously also a big part of retirement planning typically as well. And as I mentioned, it is the lowest taxed environment. So just reiterating the tax rates that over on the right there, we are potentially at zero tax within super. So as we're moving towards retirement and or in retirement, ideally we want to try and maximize typically what we get into super. And super is a structure. It's not an investment in and of itself. So should be aware of that it's a structure. So it's really about getting funds into that structure or into that vehicle. And then what you do with those funds, is then at an investment decision level. But getting it into the bucket of superannuation typically, and in most cases makes sense. The main consideration with super is the ability to get money in firstly, and then get money out. So the first challenge of getting money in, we've got caps to deal with, which I'll cover shortly. The second challenge in getting money out is usually more relevant to those under the age of 55. And obviously the younger down the scale you go, the further away you have in terms of the ability to access super. So often for younger people, there's less of a inclination to want to build their super and build it quickly because of that reason, in the inability to access it. But you've got to weigh that up in terms of obviously long-term planning and planning for your retirement as well, and the opportunities in and around that. So they're the two major considerations in and around super. So firstly, to cover off on contribution. So this is basically getting money into superannuation. So the cap since the 1st of July 2021 is $27,500, and that's for everyone. So, and by concessional contributions, they're deductible. So that means either if you're making a personal contribution, you're claiming a tax deduction for that contribution, or it's a contribution being paid by your employer, in which case your employer is getting a tax deduction. So they're known as concessional contributions, but it means there is a deduction on those contributions. On those contributions, there is a 15% contributions tax rate. So whenever that contribution is made into the super fund has to pay 15% tax on that contribution. So we need to be mindful of that. So typically, if an individual is on a personal tax rate of 90% or more, then you're going to have a tax benefit as a result of making a contribution into super. Because the personal tax rate, if it's higher than that 15%, then there will be a tax benefit. Obviously, we've got to consider cash flow. And as I mentioned, once it's in super, the ability to get it back out. But general principle, you've got a tax benefit there. We also need to be mindful of Division 293 tax, which kicks in for higher income earners. So if your adjusted taxable income is above $250,000, there's an additional 15% tax on those contributions, which means an effective tax rate of 30%. So need to be mindful of that if you're at that income level. And adjusted taxable income is equal to taxable income plus taxable super contributions plus reportable fringe benefits. So something to be mindful of if you're in and around that level. Are there any planning opportunities to try and get you below the 250K to save on that 15% Div 293 tax? The second main type of contributions there, just to add to that, from the 1st of July, there is the ability to do catch-up concessional contributions. So the requirement for that is you need to have a balance in superannuation of less than $500,000 at the end of a financial year. And you can accrue an annual cap of 25K, which was the cap prior to 1 July 21, and make catch-up contributions over a 5-year rolling period. So for example, in FY22, you could have potentially put in 4 years of cap, equating to $100,000 if you hadn't used your caps for prior years. So that can be useful if you've got high income in a particular year. For example, a capital gain, it might be worth considering, okay, well, and you haven't used prior year concessional contribution caps, might be worth considering utilising that catch-up contribution ability to use that. Yeah. Okay, so the second main type of contribution, non-concessional or non-deductible contribution. So these are basically after-tax contributions into super. So for an individual, it's their after-tax funds that they're then contributing in. So they're not getting a tax benefit on contributing in, and there is no tax in the super fund as a result as well. So it goes in after tax and it goes in with zero tax. So the annual cap applicable here from 1 July 2021 for everyone under age 75 is the 110,000. Once you're above 75,000, unfortunately, you're very limited in what you can get into super. And there is an exemption on the downsizer contribution, which I'll talk about shortly. But otherwise, yeah, once you're above 75, you're very, very restricted in what you can get into super. So hence another planning opportunity as we get towards retirement and towards that age, are we maximising what we've got into super? So the cap is nil though once your balance goes above 1.7. So once you've hit that, you can no longer make non-concessional contributions. There's also a 3-year bring forward rule that can apply with non-concessional contributions, which enables you to use 3 years of contributions to get in one lump sum under age 75. And that can effectively get you up to 330,000 in one go into super, and that's per person. So that can be potentially 660,000 between a couple, for example. So if you're wanting to boost your super quickly, that's one strategy to enable you to do that. Okay, the next type of contribution, which is reasonably new, is the downsizer contribution, and it's a good one to be aware of. Obviously, if you're looking at selling your home or have sold your home recently, but it does provide an opportunity to potentially increase your superannuation by 600,000, which is 300,000 per person. So from the 1st of July this year, those aged 60 can top up their super with no work test requirement, and that's a part of the Labor election campaign. As part of the election campaign, Labor promised age 55, but that hasn't yet been legislated. So that may come, or hopefully will come, but at the moment it is age 60. And age 75 plus can top up super as well with no upper age limit. We do need to be mindful of the impact of age pension and Centrelink as well. So If you potentially are receiving Centrelink benefits, typically your residence is excluded. So if you were to sell your residence, downsize, contribute money into super, typically superannuation assets are then included in terms of the asset test for Centrelink purposes. So just need to be mindful of that. But yeah, a very useful opportunity if that's relevant for you. And these are some of the details around the downsizer. So age 60 plus can make an extra non-concessional up to 300k each. Must come from the proceeds of the sale of a member's home, and it has to have been owned for 10 plus years, and you can only do it once, and there is no requirement to purchase another home. It applies to contracts of sale from 1 July 2018. The non-owner spouse is eligible, so if the home is owned by one individual, then the spouse can make the contribution as well, even if the property is not in their name. And it must be made within 90 days of settlement. So there is a time factor in there that we need to be mindful of. Otherwise, you will miss the boat. And a final one there, the contribution can still be made if your balance is above the 1.6 million. So that's a useful one to be able to further top up super. Whereas with non-concessional contributions, once you hit that, you can no longer make those contributions. Okay, so this is in relation to the work test, which I covered briefly already, but the work test has been scrapped for individuals aged under 75, who will now be able to make non-concessional contributions, including using the 3-year bring forward rule without meeting the work test, which is great news. So previously, between age 65 and 75, an individual had to pass a work test. So if they had retired and were no longer working or doing a level of work after age 65, they were no longer able to make contributions. But that's now been scrapped. So up to age 75, we can now make these contributions, which is great. However, the work test will still apply. I'm not sure the reasoning behind this one, but will still apply to personal deductible contributions. So we do need to be mindful of that if that type of contribution is relevant for you. So I mentioned there, be able to access the bring forward rule if your balance enables you and allows. So yeah, really positive change there, positive recent change. So this is in relation to pensions. So we covered earlier the tax rate on superannuation if you're in pension mode is 0%. So to enable that, we need to make sure that our pensions are complying. And one of the main components of a compliant pension is to be paying the minimum pension each year. So the government has extended the temporary reduction in minimum drawdown rates. So hopefully most of you are aware of that if you are in pension mode by 50% for FY 22-23. And a big one to note there is if pensions aren't paid and they're not paid within the period and that minimum pension payment isn't met, then you lose that tax-free benefit. So an important one to be aware of there in relation to pensions. This is another smaller one, not so commonly used, but one that is nonetheless still available. So there is a tax offset of up to $540 on super contributions of up to $3,000 that you make on behalf of your spouse if your spouse's income is below the $37,000 threshold. So that's a tax offset that can be useful. It's $540. So if that's relevant, contribution splitting is another one where we can split taxable contributions with your spouse. The reason we would typically look to do that is to move some balance from one spouse to another. So for example, if one spouse is a much higher level than the other and the 1.6 million might come into account either now or in future, might be worthwhile to sort of try and equalize the balance by moving some of those contributions to the lower balance member, for example. And that can be done as well. So something to be mindful of there. And the spouse must be either less than the preservation age or age between preservation age and 65 and not retired to be able to do that. Another one to be useful for, to be mindful of, which can be handy for first home owners, and I've found that as either directly for the first home owner or potentially for parents to be mindful of it as well if they're helping their kids get into a first home, is using super to save for first home. So since 1 July 2017, this has been in place. You can make voluntary and voluntary concessional and voluntary non-concessional contributions to save for your first home. There's a limit now since 1 July of 50,000, and the annual limit is 15,000. So it's a good way to effectively get a tax benefit on making contributions into super, and then be able to access those monies up to 50,000 to fund a first home purchase. And this is a client example, which we worked on with a client a little while ago, but just an example of some good planning that's really enabled them to maximise what they get into superannuation, which has put them in a really good place in terms of retirement and, you know, paying effectively the least amount of tax possible on their retirement income. So in this situation, at the time, the client had an $8 million home, $2 million in super, and a $500,000 business. They were looking to sell the business for that 500K, and will be able to, and was able to apply the small business CGT concessions and make a $500,000 retirement exemption contribution. So that's another type of contribution in relation to applying CGT small business concessions that can further enable additional funds to get into super, in addition to the caps that we've already spoken about. So that was 500K that got in there. They were also looking to downsize, which they've done, and they've made a $600,000 downsizer contribution. And they've also used the excess cash from the sale of the home to utilise the bring forward, and they were able to put in another 600,000 in. So their total super contributions were the 500 plus the 600 plus the 600, totaling 1.7. So they've ended up with about 3.7 in super, and of which about 3.2 of that will be in pension mode and tax-free. So pretty much as good a result in terms of tax on future earnings as possible there. Okay, so the next section we'll cover off quickly before we wrap up is around structuring and optimising structuring. So making sure we're using the right vehicle for investments, for business and for personal assets is always a really important consideration, and something we certainly encourage our clients to do whenever they're looking to undertake a transaction, whether that's business, buying and selling, investments, buying or selling. Always reach out and have the chat in terms of structure and how to best structure it. There's a number of different structures here, and you know, these a mix between business and also investment structures as well. But sole trader, partnership, company, trust, super, and not-for-profit are the main structures there. So what do we consider in terms of structuring? We really need to understand what the family position is and how many families are involved. So really understanding the family tree. What are the dynamics within the family? What are the relationships? Who are the spouses, potential future spouses, succession planning in and around that? What is the tax situation in and around expected income and capital? The loss situation. So are there any losses, carry forward losses or potential future losses kicking around that we obviously want to ensure we're able to utilise? What is the risk and liability exposure? Commercial considerations, which is more in relation to the business side, obviously business assets, customer and client requirements, and then set up and ongoing costs are obviously another factor there as well in terms of structuring. So if we've got existing structures in place and we're looking to change them, we do need to be mindful of consequences in and around restructuring and or selling. So the main considerations are capital gains tax, typically stamp duty, and that's obviously a big one in relation to property. So property is typically a very difficult one to change once it's already in a structure or owned by an individual, for example, because of the cost of stamp duty and CGT on changing it. But there are some strategies you can look at potentially in and around transferring some to a spouse, for example, or from an asset protection point of view, putting loans in place to minimise the equity. So there are some strategies there. Value shifting is another one, which relates typically to shares in companies and whether there's any value shift there. We've also got small business CGT concessions and other CGT rollover concessions to consider, formation expenses, practical considerations of changing, typically around business, and also timing in and around CGT and paying dividends as well. So need to be mindful of those if we are looking at changing a structure. To cover off on debt, so this is one that we're always mindful of as accountants looking at the debt position for clients, particularly understanding what their deductible and their non-deductible debt is, and how we ideally reduce any non-deductible debt and or convert that to deductible debt. And by deductible debt, it means it's been used for income generating purposes, which is typically investment or business, in which case we can claim a deduction for the cost of that debt, i.e. the interest. Whereas non-deductible debt is typically private and we don't get a deduction for interest. So how we structure debt is really important in terms of the entity, and usage of funds is typically the main consideration, in that whenever a debt is undertaken, from a tax point of view, we've got to look at where were those funds used and applied. We also need to be mindful of tainting loans. So that's if you've got mixed use debt, if you've got a loan facility, for example, where some of it's been used for private use, some of it's been used for investment or business use. How we account for that is really important. Ideally, we want to split them rather than them all mixed in together. So it's certainly something that we're always looking at to consider opportunities around how do we maximise our debt position, certainly from a tax perspective. And e.g. from a planning perspective and from a cash flow perspective, typically you want deductible debt to be interest only and non-deductible to be P&I if you're able to structure that, and if that makes sense, obviously, for your situation, but that's ideal from a tax perspective. And then in terms of any sale or restructuring, that can provide an opportunity to restructure debt as well. So just to be mindful of that, and both on businesses and investments. We have had a number of cases where there is the ability to restructure the debt whenever there's a sale or a change in ownership of assets, and the ability to then potentially convert non-deductible into deductible debt as a result of that. Also just wanted to touch on trusts here, which is quite topical at the moment. Section 100A is a section within the Income Tax Act, which essentially is and applies to trusts and discretionary trusts typically, which is designed to catch situations where an individual entity, other than the beneficiary, is benefiting from the distributed income of a trust, specifically to avoid tax, which generally results in the trustee being taxed at higher rates. So it's something that the ATO are focusing on at the moment, and really to be aware of if you're not already. If you do have a trust and a discretionary trust within your group or your structure, really need to be mindful of Section 100A and how it may apply to you and the distributions that you make within your family. And really the primary focus of the tax office is typically on and around distributions made to adult children, corporate beneficiaries and entities with losses. So how we structure those distributions, we really need to be mindful of this now because it can be applied retrospectively as well. So I just wanted to flag that as part of the discussion too. So really just to wrap up and summarise, obviously understanding the tax environment in which you're operating can help you maximise your tax position and optimise your tax position and maximise your long-term wealth. And there's constant changes in and around tax, so obviously important to be across those on a regular basis.
Sorry, Mark, we've just had
Jen.
We've had a couple of questions come up in the chat.
Okay, sure.
Yeah.
Sorry, I haven't seen those.
I think they are directed to you, Zvi. The first one's from Riley. What is priorities outlook for fixed income investments? As you mentioned, it's been a pretty horrible 12 months also to be long bonds. Do you think we are close for a pause/pivot for RBA and Fed?
Sure. Excuse me. Okay. So firstly, before I answer the question, I just wanted to add that, hopefully what you can all see is that the link between wealth creation and investments and the tax planning side and structuring is absolutely key, because you can actually get an uplift on your real investment return if you're using the right tax structures and you're, effectively optimizing your tax position. So it's always important to, even though we've split the presentation sort of in two halves, they do work hand in hand. So to that question from Riley, it's you're absolutely right. It's been a horrible 12 months to be long bonds, although, long means long term. A 12-month period is quite a short snapshot. And in fact, if you have a look at the behavior of bonds globally, in particular, if we just focus on the US, because it's obviously the largest market that we look to, the US aggregate bond index from October last year to October this year is actually, the returns have been negative 16% or thereabouts, which is almost identical to the returns on the US stock market for the years. So bonds this past 12 months have actually behaved very much like shares, which is very unusual. And it is quite challenging to know, when that might end. But the link between the capital depreciation on bond values is purely to do with interest rate rises. So if we can answer the question about, how, and this is part of Riley's second question, if there's going to be continual rate rises coming through from the Fed or the RBA, we saw just overnight the Fed raised rates another 75 basis points. That'll continue to feed volatility into the bond markets. But the silver lining to that is that the bond yields are going up quite strongly. So people who've got investments in bonds at the moment, yes, they may have experienced the capital depreciation, but the actual income generation on those investments have gone up. There are a lot of commentators who are quite bullish at the moment on bonds, even though they may not have bottomed out, and it's always going to be a very difficult task to pick the bottom. But some of the buying opportunities in bond markets now, you're looking at buying into bond prices that are much lower than they have been for many, many years. And if you have faith or believe that they'll get back to where they were eventually, and you're going to get an increased yield along the way, then, that might be an opportunity to consider. It's very clear from everything we're reading and seeing is that the RBA and the Fed will only pause their rate rises, which of course will then impact on lower volatility on bonds. They'll only pause those rate rises once they see peak inflation coming through. And we're not there yet. I think I read just this morning that some of the retailers in Australia, like Woolies, etc., are already seeing, cost of groceries, for example, are now up at going up 7.3% in the last month. So there's just still inflationary pressures coming through the system, and until that's dealt with or starts to peak because of these rate rises, I don't think the Fed or the RBA will pause, which means we'll still see some volatility in the bond markets. Aside from that, I don't have any other crystal ball to give you a date of when things will change, but certainly they've been bad. They could get a little bit worse, but in the long term, they're still a very valuable asset class to consider. Jennifer, I can see another question there from Conway.
There is. Yeah, so just, if you want to address that. So Conway is asking, could you please touch on the differences between the various types of S&P 500s which you can invest in? Example, Vanguard versus SPDR and ETF trust versus growth. Yeah,
okay, excellent. So for basically the S&P 500 is basically an index, what we call an index, and it is a conglomerate of the top 500 companies by market size in the US, so Standard & Poor's 500, top 500 companies by market capitalization, so the largest 500 companies in the US market. So if you wanted to invest in those shares in one go, by a parcel of shares that invests in those 500 companies, you can buy the index. Now you can do that in various ways. You can look at, there are a number of index managers out there. Vanguard is one of them. SPDR, which is State Street Global Management. They all offer investment funds that allow an investor with as little as $1,000 or $500, whatever it is, to buy access to those top 500 companies. In the last number of years, those managed funds or those funds have been listed on the stock exchange, and they are called exchange traded funds or ETFs. And those ETFs effectively allow a person to just on the stock exchange buy access to those investment companies. So there's really no difference, to answer your question, Conway, between Vanguard, State Street, Russell. They all offer ETFs for an S&P 500. They all invest in those top 500 companies in the actual index. So the allocation of your investment will be identical. The differences between them is they probably charge slightly different fees, management fees for that. So just have a look at the management fee component of each of those investments. But the actual underlying investment should be identical. It's the S&P 500. You can also buy ETFs that are diversified. So they might have a growth ETF that has bonds, shares, property, etc., all in the one ETF. Probably a topic for another day, but there's, you can choose balanced, high growth, conservative, and you can choose all different ones that are a mixture of different indices. So it could be the ASX 200, which is the top 200 companies in Australia, S&P 500, the aggregate bond index in the US and Australia. So you can mix them all in together and buy one ETF that gives you exposure to all of that. I hope that answers that question.
If we've got any further questions, feel free to pop them in the chat or unmute yourself. Otherwise, thank you to both Zvi and Mark for today's presentation. We hope that everyone found it informative. If you are interested in further discussing anything covered today, please feel free to book in a free financial health check with either Zvi or Mark. You can see their details on the screen there. Their details are also in the feedback form, which I've popped in the chat. You can take 1 minute to complete that. That'll be much appreciated. As Zvi mentioned, if there's any topics that you're interested in attending, please pop that into the feedback form as well. So if there's any further questions, please let us know. Otherwise, we might wrap up for today. So thank you once again. And we have recorded, as you know, and we'll send a recording of the webinar to everyone as well. So thank you, everyone.
Thank you, Jen. Thank you, Zvi. And thank you, everybody, for your time in attending today. Hopefully you all got something from it. And yeah, myself and Zvi would love to chat on anything we've covered today or anything else. So please feel free to reach out to us directly. And yeah, as Jen mentioned, it'd be great if you could fill out that feedback form, just so we can get some feedback and also topics of interest that might be relevant for us to do in future.
Thank you.
Okay, great. Thanks, everyone.
Thanks, everybody.
Okay, bye-bye.
Have a good day. Bye.